Thank you very much for coming this afternoon. Today I chose to talk to this group. We are, of course, at a university, so we should be talking about things involving science and university-type activities. And what I wanted to do is talk to you a little about the field of finance, since that's my expertise. That's probably wise. And I wanted to take you and sort of explain sort of what finance is and why it's important, and particularly because it's been in the news a lot for the last 10 years, to give you maybe a different perspective. So let me just start by first saying that the financial system is really, really important. A well-functioning financial system is essential for the growth, development, and stability, for that matter, of economies. That the idea that there's somehow the real system, the real economy, and the financial economy is a fiction. It only appears in out-of-date macroeconomics books. Okay? The two are inexorably linked. My colleague and fellow Nobel Laureate Robert Solow won the Nobel Prize for his work on growth. And what he showed was that it was technological progress that drove growth, not population growth, not frugality of savings, the two usual or traditional explanations for growth. It was technological progress. That was a very important contribution which was recognized. However, I would remind you that at my university, MIT, we have a lot of technology being developed. Everywhere you look, it's a very exciting place. And if you ever get a big head, you walk around there, it gets very small quickly. They're very good. However, if all of that technology does not find its way broadly into the use in the economy, you'll never see the growth in the economy as a consequence of that technology. It actually has to be implemented broadly and deeply to have the impacts that Solow found. The financial system is critical to that. And that's why it's essential to that system. Now, the financial system is improved through financial innovation. And what drives financial innovation are finance science, our understanding of it, technology, computers and high-speed things and data and everything. And then, most importantly, to get implementation, economic need. If you don't have an economic need, it doesn't get done either. So you need the three. So there's a dynamic. The financial system is important. It's improved by innovation. Innovation, implementation is driven by these three factors. Now, finance I mentioned is a science, and some people say, well, is it really a science? And the answer is yes, it is. It wasn't always. It's a little bit like parts of biology that, until DNA, it was a very different world. And finance, I don't think, was principally just a bunch of anecdotes and present value and a few other rules and accounting identities. Really not organized. But in the 1950s and 60s, it became a science in my view. That's where I date it from. Now, what makes it a science? A series of theories and principles and hypotheses that can be refuted, substantial and important data that can be used to confront the hypotheses, and a process of applying data and subjecting these things to the testing. There were no data, materially put together data in finance prior to this time, but it was put together. Now, I'm not going to go through each of these. Those who've studied finance, here's my list of where the science, the contributions to science at the beginning. I put the beginning of the science, I marked with Harry Markowitz's work on Portfolio Theory in 1952, Ken Arrow's, the role of security markets in 1953, and so forth. Now, it's a science. I mean, if you look at it, it's all done there. And by the way, there have been about 6 or 7 Nobel Prizes connected with work in finance, so you could argue that's a reasoning. But I'm not giving you an institutional answer. I'm saying structurally, it really is a science, and it's been subject that way. But it's a young science. Harry Markowitz, knock on wood, is not only still alive, he's working. He's still writing papers and giving talks. Now, when the person, he's not the founder of the science, but the person you identify as the marker for the beginning of it becoming a science is still alive and working. It's a young science. So we've got a lot of ways to go. So that's one that I just want to put through, I've gone through. Now, I'm going to take you through a little history. You don't usually get this probably in most of your finance courses. But I want to take you a little history because I think this is a history you can learn something from. I'm going to start a long time ago. Long time, doesn't seem long to me, but it was a long time ago, 1970s. And, you know, you've all lived through or at least read about the crisis, financial crisis of 2008, 2009, almost 10 years ago now, right? Usually that is compared with the Great Depression, the 1930s. I don't know quite why, because I don't see that connection. The 1970s, though, was a pretty exciting time in terms of crises, and I don't know why it's not mentioned. And so I thought I'd just take you through that to show you how things happened. From the 2008-9, what did you see happen? Crisis, and what was the reaction? Financial innovation is causing this. There's too much stuff going on. Slow it down, slow it down, slow it down, down, down. That may have been the right answer. I'm not going to debate that. But it's not the only answer. It isn't how we normally always describe the crisis. The 1970s was very different. So first of all, let me suggest to you why I think this is a pretty good, interesting period of crisis. It was a period where several large shocks hit, no particular order. The fall of Bretton Woods. It used to be for a generation, currencies were all fixed. You didn't have to know exchange rates, they were fixed. Nobody even worried about it. Suddenly, overnight, all the currencies start flashing up. Risks that we hadn't seen for a generation. That's a shock. The first oil crisis, we didn't know the number of them. Oil went from $2.50 a barrel to $14 a barrel. There were long lines to things and so forth. That's pretty big. We had a second one by the end of the 70s. What else was going on? In the United States, we had double-digit inflation. Now, it's hard to believe in the world we live today, but we had over 10% inflation rate. We had not seen that in the United States since the mid-19th century, since our Civil War 100 years earlier. So there was no one who had any experience with that level of inflation. That's not modeling. They didn't even, no one had lived with it. What else? And not surprisingly, with double-digit inflation, you had double-digit interest rates. Long-term, short-term treasuries, full faith and credit, over 10%. Before the end of the decade into the next one, the short rate went to 21%. That's a lot of interest rate, big shot. We had regulations that wouldn't let banks pay more than 5% on deposits. You don't have to be a rocket scientist to figure out if you can get more than 10% on full faith and credit government, why would you put your money in the bank at 5%? If you don't put your money in the bank, where do the banks get money to finance housing, for example? There was no money for housing. Didn't matter how good a credit you were. Okay? What else happened? High unemployment. Not quite the peak we got this time, but over 9%. Now think about that. 10% inflation, 9% unemployment. Any economist at the time would tell you that can't happen. In fact, we figured out, right, how to cure these things. If you have high inflation, you tighten. If you have high unemployment, you loosen. What do you have when you have high unemployment and high inflation? You don't know what to do. We called it stagflation. I asked my macro expert friends, what if stagflation comes back? Do we know what to do about it? They tell me no. So let's hope it doesn't come back. So we had stagflation. The stock market fell 50% in real terms in 18 months. So I don't want to be like a comedian up here who says, you know, when I was growing up, I had a dirt floor, and the other one says, yeah, but at least you had a roof. I'm not going to see who's got a worse recession or worse, but this was pretty bad. Shocks from every part of the world, shocks we hadn't dealt with in our lifetime, in anyone's lifetime at that time. Now, what was the reaction to that? An explosion of financial innovation. Quite the contrary of 2008, 2009 reaction. Instead of saying, cut back, they said, oh my God, we have all these risks. We have to find a way to deal with them. So we created an options exchange, the first one, first listed exchange. No experience, none. There was no history, there was no experience to draw on at all. But options, as you know, are insurance. It created insurance money, value insurance. Options on stocks, options on other things, but particularly stocks. What else happened? We created financial futures for currencies, which were now floating, interest rates and stocks. You could understand if interest rates are 10%, 13%, 12%, 9% fluctuating, that's a lot of risk. Okay, what else happened? Money market funds. I'm not going to go through each one. Index funds. How many people know what they are? That's standard thing you all heard about, trillions of dollars. They didn't exist until then. The first one was in 1970, Stagecoach Fund. The first big one that for the public was Vanguard, which was created in 1975. Now that's traditional. That didn't exist. And in fact, international diversification. Anybody who goes into, if you're in some kind of a retirement plan or anything, you get advice. They always say diversify, world diversify, right? Buy portfolios. In 1970s, that wasn't happened. The first time I know of a major institution having global diversification, or at least outside the United States diversification, as part of its core investment strategy, was TIA Craft, the big insurance companies for professors, which Paul Samuelson was a trustee and said, I think this is a good idea. So it was in the 70s where we had the innovation of international diversification that we take for granted. What else happened? We got rid of fixed commission. We had cartel and commissions. Institutions paid the same terms as individuals. You bought 100,000 shares of stock, you paid 1,000 times the commission if you bought 100 times shares of stock. That created the environment that you are living in today, that's the institutional financial system. That was a key element. What else happened? We created a national mortgage market. Housing's very important. Housing's very important here in Singapore, for sure. I don't have to tell you that. You have the highest ownership rate in the world as a country, okay? After the experience of no money, no matter how good a credit you are, we created a national mortgage market that was actually created global financing for the residential real estate in the United States. Since that time, there has never been a time in the United States where you couldn't get mortgage money. The price changes, but you always had availability of money. People take that for granted. Most all of you weren't even born probably in 1970. So that's all you've ever seen. That wasn't the way the world was. What else? We got rid of some things. We opened all the derivatives markets. But the connection with science was that all of this innovation would not have been possible if we hadn't had the mathematical models, the computers that did it. In the case of the options market, we had no experience. And science, finance science, real science, not derivatives of that, but the main core, most advanced science found its way into the mainstream of applications right then and there because of need. There was no choice. And this has created culturally, in my view, the tradition, if you want to, that the highest of finance science, empirical, theoretical, and so forth, gets engaged and involved in finance practice in the mainstream. That linkage is quite unusual. You don't find it in most other branches of economics and most other things, that practice and high science are that close. Closest to it I can think of is modern biotechnology, which also evolved out of a big event. Okay? So the message for you was the response here was huge amounts of innovation to solve the problem. But I want to point something out to you. Sometimes when you have a crisis, it's like a fire in the house. What do the firemen have to do? They want to save lives and get the fire out. They come and they break the windows and the doors and everything. Whatever they have to do to get people out and save the fire. That's the right thing to do. But then what do you have afterwards? A mess. Broken windows, broken doors. Not a good thing for the long run, but it was necessary. And that sometimes happens in financial crises. We do things that we know are not good for the long run, but there'll be no long run unless you get through the short run. These innovations, if you look at them, were quite different. Every one of them not only helped solve the problem at the time, but have been delivering to society for the last 40-odd years. I mentioned the mortgage market. I mentioned all these different things. These were innovations that were permanent value creation, not just in the moment. Very different. And now if you want some evidence on that, beyond my telling you and your own experience, these were created in the United States under crisis conditions. But these markets, as you know from your studies, have been adopted just about everywhere in the world, the derivatives markets everywhere, including here in Singapore, of course. Now, they weren't adopted under crisis conditions. They were adopted by governments under conditions where they had a choice. They made that choice. Now, unless you think all these governments were masochists, that they were bringing something bad in on purpose, I think that's first best evidence that at least most of the people in the world looking at these saw these as improvements to society. And I want to show you these because you're so used to them, you don't realize they weren't always there. They weren't. And this all happened in an explosion of time, both intellectual explosion in the field as well as in practice. So that's the 1970s. Okay? Now what I want to do, I'm going to move forward, but believe me, we'll get to today. I have a forte into the future, so don't worry. This isn't a complete history course. But I'm going to bring you forward through a series of examples of what I say here. Intangible. Most of finance is intangible. There's no bricks and mortar. You can't point to it. And so if it's not tangible, it's not real, it can't be important. You know, hardware and software. Software is intangible. That's not valuable, is it? Of course it is. So tangibility isn't a test of importance. Finance is largely intangible. It's contracts, it's design, it's organizations, and so forth. What I'm going to show you here are some examples of finance through the decades where it's had a big impact on the real estate. I want to show you one from the 70s because I want you to see that connection that I started with. So the first one comes from the 80s, then I'll have one from the 90s, and then we'll come up to today. Ready? Okay, we're going to go. Let's go with the first one. The first one is banks, good banks, banks that did the right thing, who served their customers. They had two kinds of customers. Borrowers for real estate, for their home, for their business, their education, whatever. Borrowers. And depositors were their other ones, right? They put their money in. Now, you could understand in my 1970 stories, if interest rates were fluctuating at double digits, and you're in the construction business and it's going to take you 5 years to build a building or 6 or something, it's pretty risky for you to borrow on a floating rate interest rate because interest rates could go up 1, 2, 3, 400% basis points. You could go bankrupt. So they wanted the safety of a locked-in price. The same thing with people. They borrow money to buy a house, and suddenly their interest rate goes way up. They can't afford to pay it. So they wanted fixed rates. Why? For that purpose. What about the depositors? They wanted to get their money anytime they want, right? They want to be able to get it out full amount. So what did that mean? You couldn't have a fixed rate for them. It had to be the floating rate, short-term rate. So to serve those two key customers, what did the bank have to do? It had to lend at fixed rates, 5 years, 10 years, sometimes 20 years, 5, and source money by borrowing on short-term basis. Did that create a risk for the bank? An enormous risk. Their revenues are fixed, right, because you've locked in a price, and your cost of funding is whatever it is. And if the cost of funding goes above what you're being paid, you're in a lot of trouble, probably insolvent in many cases. That risk is so big that it was the biggest risk in banks. It was bigger than credit risk. And the only thing that kept banks from periodically all going bankrupt, insolvent and bankrupt, was government intervention, essentially forbearance, saying, don't worry, we'll look after it and hope that things get back to normal. Overnight, one simple-to-understand innovation eliminated that risk forever, everywhere in the world. It was called the interest rate swap. And even if you don't know anything about what it is, it's a contract pretty easy. It simply says, he and I enter into a contract. If I'm a bank, my revenues are coming fixed, right? Because I agreed to a fixed revenues. But I have to pay a floating amount, and that's my risk. So I enter into a contract with him that says, I'll pay him a fixed amount, less than my customers are paying me, so I make some money to pay my employees and my capital and stay in business, right? And in return, he'll pay me a floating rate. depending on what current interest rates are. It's just a bilateral contract. Exchange, we don't pay anything for it, we're just exchanging risks. What does that do for the bank? Well, as you can see in the picture, I receive fixed, I pay him fixed a little less, so I make a little money there. I receive from him a floating amount, a little more than I pay to my depositors. I make money there. You see, I've eliminated my interest rate risk. The biggest risk in banks around the world. Overnight, simple contract. It was not simple to implement this at the scale it is. There's 600 trillion US dollar notional amounts of these sloshing around the earth. And they work very well, by the way. Today, you don't know whether a bank will be better off or not if rates go up or down, because they can make their exposure to interest rates anything they choose. That's why I say it's forever been eliminated. Simple contract eliminated the biggest risk in banks. So I thought that was worthwhile pointing out to you. Simple contract. Okay, let's move forward. The left side shows you what it was like for banks before the swap in terms of their position. A little variable. That's all from interest rates, nothing else. Okay? The right side is what happens after you swap. You see there's not small. Okay. Next, I'm going to bring you, we're making progress. We got through the 80s now. That was an innovation in the 80s. Oh, by the way, I can't resist this. This is local U.S. story, but you don't mind if I share a little provincialism with you. We have a former chairman of the Fed, very well-known former chairman, who made the statement about innovation that there hasn't been a single financial innovation that's been valuable to society since the ATM. You know what the ATM is, right? Now, of course, you know the ATM is not a financial innovation. It's a processing machine. It has nothing to do with finance. Anybody know when the ATM was invented? 1969. I show you a little bit that happened after that in the 70s. I showed you now the interest rate swap, which took the biggest risk out of banks around the world forever. That's the 1980s. Interesting comment. Okay, let's get to the 90s. 1990s, I'm going to take you now to Europe, to Germany. There was a reunification of Germany, East and West. It was a deal that they wanted to do. And as you're probably aware, the East was not in the same economic condition as the West. And one of the policies that they wanted to have as a new unified country is to bring the East up to the economic level of the West. That's what they wanted to do. So there was a city of Leipzig, if you look on the map. By the way, you can get these slides. If you hear anything this afternoon that interests you, you'll provide the slides to you so you can remember what it was that you were interested in. So you don't have to take notes or something unless you just like to do that habitually. But in any case, the city of Leipzig was in the East. And in order to grow, it wanted to increase the amount of electricity it could produce. Now, it produced electricity using natural gas. So it had to get more natural gas. And how did it do it? It said, well, let's look around. And they got the engineers or something. They put out a thing, can you give us more natural gas? And they got two offers, two options, two choices. Choice number one is take your gas from the West, the North Sea and so forth, from the West, bring it in. You have to build a little pipeline and bring it in. And you pay market prices for gas, okay? And that's it. The other offer came from the East, from the Russians. They offered, a consortium offered, 15 years fixed price for gas. So many Deutschmarks, because this is before the euro, so many Deutschmarks per MCF. Okay? So you understand it's a fixed agreement for 15 years, fixed price. Now remember, the people who were running the city managers of Leipzig, are the same people who were the city managers before the unification. They're the same people who were the city managers when it was a command and control economy. So they were smart people, and obviously they understood their city, but they were not financially sophisticated at all. That's important to keep in mind for this. They looked at this and they said, this is a little bit like the famous question, which would you rather do, burn to death or freeze to death? Do I have a third option, is what I would say. And reason was, if they took the gas from the West, That'd be fine, but what happens to the price of gas? It fluctuates, right? This is an economy where people used to a fixed price by command and control, not for each month or each year, but basically indefinitely. And you're suddenly going to introduce the kind of volatility in people's electricity and gas prices every month? You want to be the politician that deals with that? That's not practical, right? But then you look at the Russian one, and you say, well, you know, sorry, nothing personal, but if they're controlling our supply of energy, that's a little bit nervous to begin with. We've seen some experience in more recent times that that's not unfounded. But the problem with them is if they have a fixed price, then what happens? Say the fixed price is X Deutschmarks per MCF. Now suppose the price of gas falls after you do this contract. So in the West and everywhere else, everybody's paying X over 2 for their gas. What do you pay? X, because it's a fixed contract. Would you like to be the politician that explains to people why your city is paying twice the price for gas that everybody else in the world is? Now, we all know that about hedging, that you hedge for risk, and try explaining hedging to the population who sees the price at twice the level of everybody else. Well, we put a hedge on, so you have huge political risk. So you understand why they didn't feel very good. Now, this is a true story, and it's old enough I could even tell you the name. A bank got word of this was going on, and this bank had a part of it whose job it was to find solutions to problems. That's what they get paid for. And they had a lot of very sophisticated people, sophisticated in their training, like those of you who are training in finance. And they said, can we come up with a third way? And they did. The bank was J.P. Morgan, the old J.P. Morgan. Okay? And here, first let me tell you what their solution was. Then I'll tell you what it took to get there. Because there's a point to this. They came to the city managers and said, we have a deal for you. Take your gas from the West, option 1. Buy it at whatever the market price is. It's a US dollar market, so you have currency risk, you have all kinds of things. But buy it whatever it is. Anytime you pay more than X Deutschmarks per MCF, that's the Russian price, anytime, we'll rebate you any amount above X. Otherwise, you pay the market price. Now, think about if you're the manager. Which is better? Always pay X, or never pay more than X, but sometimes pay less than X. Is that a hard decision? No. That's how you design. A good design in finance is one that is simple for the client to understand and make the right decision. But as often happens, like the lady who's the ballerina, she wants everything she does for us to look effortless. But of course, if you're close to her, she's killing herself to make it effortless. She's perspiring, her feet are all black and blue, because she wants to make it look effortless. That's what you do in finance with good solutions. Complexity belongs with the experts, the people who do it for a living. Simplicity is what you want to offer to clients, not complexity. So this was ultimate. It was very important because of the lack of sophistication. It didn't take a lot for them to make that decision. Now, how were they able to do that? Well, there was a huge risk that the bank was taking because they're guaranteeing this. They're not saying we'll do best efforts. This is a guarantee of the bank. What risk was the bank taking? Well, the price of gas. Of course, gas is quoted in dollars. So you're also taking currency risk, Deutschmarks. Those of you who understand it, what have they done? They've written what's called a cap. They've ensured that you pay no more than a certain amount. That's an option. If you're valuing or taking option exposure, you're not only directional, but volatility, changes, uncertainty affect the value. So they were exposed to a whole lot of risks. And at that time, in the markets, if you look on the left side, there were relatively few markets available for hedging. So it took a lot of sophisticated analysis and a lot of skill sets. So they had to use oil as a substitute for gas, so they had to take account. Lots of complexity. That's what I want you for the bank. But that's what they do for a living. That's what they do for a living. So that's okay. Question is, though, in finance we teach I like to teach. I always say if I could teach one finance rule to children between kindergarten and 12th grade, one, it's there's no free lunch, and if it looks too good to be true, it's probably not true. If you learn that, you stay out of an awful lot of trouble and probably not lose much. So how is it that this bank, which is clearly out to make money, was able to give a clearly better deal to Leipzig than Russians? Were they highballing? No. The reason they could is, if you go back, the Russians, to do their deal, had to bring the gas from the east. They had to build a big pipeline. It cost $300 million. Now, that may not sound a lot today, but that was a lot of money for the city of Leipzig in 1990. Instead of a $50 million pipeline, if they brought their gas from the west, physically. Russia had to recover that $300 million. It's not doing it for free. So the price they charge had to cover that cost. So what do you see? Physically, since we're taking it from the west, we saved $250 million in pipeline cost. And that's where it came from. The bank took 125, and Leipzig got 125. Leipzig got rid of its political problems because they always had the best price. Okay? So it wasn't that the Russians were inefficient or anything. You just took 250 real millions of dollars and you saved it, and part of it went to the expense. The bank didn't make 125 because they took all this risk, had to pay people and everything. But that's how it was done. That's the answer. J.P. Morgan, by the way, was a better credit than Russia. Okay? So it wasn't like there was some deal that, yeah, they're offering a better deal because they may not do it. They're much better off taking J.P. Morgan's credit, and I don't think J.P. Morgan would invade East Germany. So, that's the answer. So it was a pure efficiency gain. Everybody was better off. The bank did nothing physical. They didn't build a pipeline. They didn't do anything. They didn't put any pipes. They didn't do anything. But by reorganizing the resources and moving the risks around, they were able to do it. But there's an answer to this that's also very 2017. What else happened? We all know that pipelines are dirty. They're not good for the environment. No one argues about that. Not even anyone in my country won't really argue that. But we do them because maybe the benefit for energy is worth it. What happened here? As a result of reorganizing the resources, a big, nasty pipeline wasn't built, the one from Russia. That's green. So this didn't just increase efficiency, give the city of Leipzig more resources back, and get rid of a potential political problem. It also was a green solution. And that's very much today. All out of an intangible use in contracts and reorganizing the same resource. Just so you don't think that this is a random event, the Tennessee Valley Authority of the United States at one time producing 1/6 of all the electricity in the United States, much smaller now. In planning for the 21st century, they put out contracts that they would buy calls on electricity and sell puts, sell insurance, buy insurance, okay, to anyone who was actually connected to the grid, not the financial people, but people who could deliver electricity. Even people who have like some solar panels on their farm and they could sell some extra electricity, they call them mom and pop, really little ones, all over. Anyone who was connected to the grid could get these. As a result of offering these contracts, TVA acquired enough electricity through contracts, they didn't build 2 nuclear power plants. That's like 35 conventional power plants. Once again, green. Green because of reorganizing the resources that were already there, using markets and shifting the risks around. They were able to get capacity that existed, but there was no way a centralized planner or government could ever have put them all together to organize this. Not TVA, not any of them. They used the markets and contracts to do it. So again, a green solution. Now, I've shown a sign, I've got 10 minutes, but I have, I promised you I'll take you to 217. There's something in the moment. But I really wanted you to see these others, a variety in time and space, to see that finance can play a very important role. If you are in finance, This is the kind of thing you can do that has real impacts on real societies in a major way. Okay? Here's the new one. Don't get worried about the pretty colored sign. I'll explain them to you. This has to do with stability, financial stability, in competition with economic growth. We all know that China has a kind of deal with its country, itself with we promise the people growth. But we also know that China has something they put ahead of growth, and that's stability. Stability trumps growth. That's the most important. I didn't say that, that's just what it is. And sometimes they conflict. So when the stock market this has been going on before that, when the stock market cracked in China in 2015, a whole bunch of things were done, and there was worries about money flying out of the country, so they put all kinds of capital controls on. And China's not the only country to do this. It's very common when they worry about an outflow of capital and so forth, you put capital controls on for stability. I'm not going to debate whether that's a good idea or not. Okay? That's not my specialty. But what are the impacts if you impose capital controls on your country? Let's say complete capital controls, just because it's easier to talk about. Where does the capital have to come from? It all has to come from inside, because you can't get it from the outside. Where do your people in your country invest? Only on the inside, because if there are capital controls, you can't invest on the outside, right? There are many costs to that, but one of them is loss of diversification. Now, you've all learned in finance, right, the trade-off of risk and return. We all like high expected rewards for the risk we take. Now, the best diversified portfolio, diversification is you buy everything, is the world portfolio. And this is the picture of the returns for this period from investing in the world portfolio. This is expected return, that's risk, that's the menu you could have gotten. If you're a low-risk person, that return, if you're a high-risk person. But this is the menu that you would have gotten by investing a mixture in the world portfolio, the best diversified portfolio, with risk-free assets and a modulator. So it's like a menu in a restaurant. That's what you could have gotten. If you only invested in China, that's what your choices were. Do you see, for the same amount of risk, you did a lot worse than in the world? That's a cost. Now, it isn't fair to look at the aftercome on China. Why? Because nobody knew what was going to happen in China. Maybe it's bad luck. You make investments beforehand, not after knowing what will happen. So just looking at the after is not a measure. So what I did is ask the question, given that the world did this in this period, what did I expect China would have done if China neither underperformed or overperformed expectations? In other words, if China performed as expected, conditional on what happened to the world, what is my forecast for what China? Does everybody get the experiment? Not what did happen to China, what do we expect to happen to China? That's the relevant thing, because we don't know. After the fact, buy low and sell high is always a good idea. I did that, and those who want to know how to do it, you just apply the CEPM, take the beta of China times the excess return on the market, add the risk-free rate, 0 alpha, that's your forecast. There may be a better way, but that'll do. That's that number. That's the expectation. This is the comparison that shows the cost of only investing in China. For the same amount of risk, you expect to get that return versus that return. Can you see that from a picture? You don't have to be a finance expert. This is risk that you don't like. This is the reward for taking it. You get more reward here than you get along here. You see you prefer the red one to the green? The difference, therefore, is the cost of not being able to diversify globally. It's a very big number, by the way. And it's true of lots of countries. Okay? Now, you say, well, yeah, this is not good for the economy. They get much lower returns for China and their investors and their population and their institutions. If they just invest in China, that's what they get. Okay? But maybe it's worth it for stability. I'm not going to argue that. What I do want to show you is how finance technology can do something to get rid of this cost and still implement the policy of capital controls. I don't want capital controls, or I do want capital controls. I'm not answering it. But if you're going to do capital controls, would you rather have capital controls at lower cost or higher cost? I think we could all agree lower cost. I like to do things where everybody agrees if we do it. So what do I show you? What did I do? The old swap. Same thing we did for banks. So all the Chinese institutions buy all the China A shares. They own them all because no one else can have them. And then what did they do? They enter into a swap contract, this time not floating for fixed interest rates, but this institution, NCSFF, that's the pension system of China, CIC, its sovereign wealth fund, SAFE, its reserves, holding all these shares, they enter into a contract where they agree to pay the return on China's shares, which they own, and in return, their counterparty pays back the return on the shares of the world. You see, that's an exchange of returns. No money, no investment, just exchange, just like the swap. So what happens if China did that? China holds the A shares, they vote them, they govern it, everything that you want, all the money is invested in them in China. But then the return from China is paid to, say, Norges Bank, that's the sovereign wealth fund of Norway, or GIC here in Singapore. And Singapore, GIC, or Norges Bank gives them the world back. What is the return that they then get? The return they end up getting is world. They earned A shares, they paid A shares, they received world. You've now gotten China, from an investment point of view, fully diversified. But what's true? You haven't violated the capital controls. Actually, you've improved them. That's what I wanted to show you. Why not? All the shares are owned in China. They were all bought in China. They're held by Chinese institutions and individuals. Nothing was paid for the swap, so there's no capital flow. Well, the swap's going to pay sometime, right, with the exchange. Does that violate capital controls? Not really. Why? First of all, those payments happen on a scheduled date. They're not people pulling their money out, causing panic. You know when those payments are going to come. But the most important piece for you to see is what? When does China have to pay on this contract? When does China send money to GIC or to Norges Bank? Well, remember, China's paying China returns, and it's receiving world returns. And, of course, the payer is the net. So the only time China pays anything is if China outperforms the world, because then they owe more for the China shares than they are receiving back from GIC. Are those bad times for China when its stock market is outperforming the world? I don't think so. Is that a time when you're worried about everybody running out of China with the money? I don't think so. So although money does flow out under controlled fashion, it actually is better for stability than not doing this. Why? Because if you don't do this, you have no flows. With this, you get flows in when China does poorly, because if China underperforms, GIC sends a check. In return, when they do send a check, it's when things are better. You've actually made China more stable. I'm trying to give this as this is real world, this is doable today. There are no contracts, there's no legal things, there's nothing you have to change. The counterparty, people worry about credit risk if you do this for hundreds of billions of dollars. The counterparties are Norges Bank, GIC against CIC, CSNC. They're the biggest. They know each other. You can put all those people in one room, not much smaller than this room. This is very practical. We've been doing these kinds of swaps for decades. There's nothing new here in that regard. Everybody knows these contracts work. They've been adjudicated for years. There's no new contracts. What am I showing you? In 2017, a big problem for a country. Not alone China, but China's big. A rough estimate of the cost, if they were fully capital controlled, is 3% a year. To scale that for you, 3%, your money doubles every 24 years. So that 3% cost would double the amount of money in NCSSF, the pension fund of China, in a generation. That's a big number. So this is a big event, big important risk. You see it's a real challenge. Who knows? Stability may be more important. But if we could take out that cost, everybody is better off. Here's an example of financial science solution from practice. It's non-invasive, and by the way, if you want to reverse it, you just reverse this well. It's very doable. And that's what I wanted you to see here today. Today, big issue, here's a solution. I'm sure if you put your heads to it, you can come up with a better one. Well, I think on that note, I better stop because I've run over the meter. But just to recoup, if you look back over the history, decades, finance has contributed significantly to the welfare of society, not just on a crisis basis, but on a permanent basis. And you see that you can take big challenges, like the one I described for China. And China, again, is not alone. This same problem with capital flows occurs in all kinds of countries. And the solution exists to be used in all kinds of countries. So you have an opportunity in finance, if you use the tools right, that you can have a major impact on society for a long time. We have retirement system challenges. I've been working on that for 13 years in practice. There are plenty of them out there. And some people have said, oh, Professor, I wish I was born back then. You were so damn lucky that you came in just at the time when the whole world was taking off and you wrote this stuff and there was a need. And they're right. If we had published our paper on options 10 years early, it wouldn't have have been published, that's been it. But we came up with a solution exactly at the time when it was needed. And something that came out of pure theory was adopted into absolutely Main Street practice. Everybody in the world was using it in 2 years. Those of you who are entrepreneurial, don't think that's the norm. You don't come up with an idea and in 2 years it's used everywhere. I had a second idea. I published a year later after this. It was an instant success 25 years later. That was my credit model. I published it in 1974, and except for some hedge funds, prop desks, nobody used it. In 1990s, late 90s, all of a sudden, everybody in the world started using it. And the answer was, no surprise, it worked, and the other models didn't. And Wall Street and the world are pragmatic. When they have something that's a problem, the current thing isn't solving, and something solves it, they adapt it. So, 25 years, 2 years, better be prepared for it. If you're an innovator, it doesn't go the way that, hey, do an app, 90 days later, sell the company and do another one. That's a production theory. That's not entrepreneurship. So it's not easy, but it can be really exciting. And I'll tell you, it's really fun, good feeling when someone says, what did you do the last 10 years of your life? Made life a little bit better for an awful lot of people for a long time. So I hope I've at least given you some inspiration that if you're studying this field, it's worthwhile, not just for the intellectual challenges, which are, right, and not only for the money. And this is one of the highest paid legal professions in the world, okay? But you can also say it matters what we do in a big way. Thank you again.